Hello, everyone, and welcome to today's webinar, Sink or Swim, Keeping Your Nonprofit Afloat in 2021. My name is Carrie Minnick, and I'm a director here at DWD in charge of our nonprofit team. Today, we really wanted to share with you some things that we think are important that are going on in the nonprofit sector. First, we'll go over some of the government assistance programs currently available to nonprofit through the pandemic. Also, we'll go over some updates with the OMB compliance supplement, general accounting, and also some tax items from the IRS. Finally, we'll go over some controls for remote workforce, fundraising, and budgeting during the pandemic. The first item we will discuss is the Economic Injury Disaster Loan, or the EIDL. Some of you may have already received this type of funding. This is a government funding that's issued through the SBA. As I said, it is issued through the SBA, and that you also have to apply on the SBA's website for this funding. The application period has been extended to December 31st, 2021. And the purpose of this type of funding is to meet financial obligations and operating expenses that could have been met had this pandemic had not occurred. The funds can be used for working capital and normal operating expenses, and most nonprofits are eligible for this funding. As I said, this is to pay for normal working capital, and the amount that is available to each nonprofit is up to 6 months of working capital. The terms of the loan include a 2.75% interest rate for nonprofits. The loan matures after 30 years, with the first payment being deferred 1 year. There is no prepayment or penalties of fees if you wish to prepay on the loan, and collateral is required for loans over $25,000. Now, the SBA was issuing an advance, and this was more of a grant as opposed to a loan. It was $1,000 per employee up to $10,000 maximum. So this was really a forgivable loan, considered a grant. However, this is no longer available. You may hear that the SBA is considering some direct targeted advances. In these instances, nonprofits do not need to apply for this. If you are eligible, the SBA will reach out to you to contact you about this. But this new targeted advance has not been started yet. So currently, the only items that are available through the EIDL are the loans. Next is the Paycheck Protection Program, which many of you have probably received. This is also through the SBA. However, the PPP funding is not applied for through SBA. It is applied for through your local banks. This was, the application period was closed. However, in January, it was opened back up, and it is now open through March 31st. And I have put a link on the screen of where you can go to look at the application if you are interested in applying, if you haven't already applied. So as I said, they did reopen the application period for this. So those of you that have not received a PPP loan and maybe are eligible or want to go for that, you certainly can. So we're firstly going to talk about the first draw loans. There is also a second draw loan. But first, let's talk about the first draw. So these are for organizations that have not received any kind of PPP funding yet. So the purpose of this funding is to help businesses keep their workforce employed during the pandemic. In order to be eligible for this funding, your organization has to have been in operation on February 15th of 2020, and 501c3 organizations with 500 or fewer employees are eligible. This also includes churches and religious organizations. They also recently announced that 501c6 organizations are also eligible for PPP funding. However, there are some restrictions on 501c6 organizations. Instead of the 500 and fewer employees, you have to have 300 or fewer employees. And there are also some restrictions on the amount of lobbying that the 501c6s have. You also have to sign a good faith certification that the current economic uncertainty makes the loan necessary to support the ongoing operations. Because really, again, the whole purpose of this program is to make sure that you can keep your employees, your individuals' employees keep working for you during this time, and so that you really need this money to pay for their salary for the ongoing operations of your organization. And also, if you receive or are going to plan on applying for a shuttered venue operators grant, you are not eligible to get a PPP loan. So organizations cannot receive both a shuttered venue operators grant and a PPP loan. And we will discuss the shuttered venue operators grant in a few minutes. The amount available for the PPP loan is up to 2.5 times your average monthly payroll costs during 2019 or 2020. There is a cap of $100,000 per employee annualized, and this is per employee as opposed to full-time equivalents. Again, the first draw from the PPP loan is limited to $10 million. The terms of the loan include an interest rate of 1%. Loans issued prior to June 5th, 2020 have a maturity of 2 years. Loans issued after June 5th, 2020 have a maturity of 5 years. And there's no collateral or personal guarantees required, which is really great. And also the best thing is that these loans may be forgiven. So in order to be forgiven, you have to spend the money for a specific eligible cost, and we'll talk about those in a little bit. 60% of the proceeds must be spent on payroll costs. There are some additional eligible costs that you may spend the funds on. However, 60%, at least 60% of the proceeds must be spent on payroll costs in order for the loan to be forgiven. The remaining funds must be spent on these eligible expenses. And then also there's a test to determine if your employee and compensation levels have been maintained. In order to apply for the forgiveness, they just recently issued a new form for those that receive $150,000 or less in funding. So if you did receive $150,000 less in PPP funds and you haven't applied for forgiveness yet, you are eligible to use this new form. It's a simplified form, so you don't have to provide as much documentation as previously, just a one-page form where you complete the questionnaire and sign it. And give it to the bank to request the forgiveness. There also used to be a requirement where the EIDL advance, that up to $10,000 forgivable portion of the EIDL, would reduce the amount of the PPP forgiveness. So for example, if you received a PPP loan of $70,000 and you received the EIDL advance of $10,000, you would only be able to receive forgiveness of $60,000 of the PPP loan. However, they have now changed that, so you will be able to receive the full forgiveness, $70,000. Of course, that is if you meet the forgiveness criteria. They are still in discussion as to how the $10,000, if you already have applied for the PPP loan and you did get that EIDL advance and you did not get the full forgiveness of the PPP loan, they will make that right. They will correct that, so you will get that full forgiveness. They just haven't come out and specifically said how they're going to do that yet. So let's talk about the eligible costs. So again, in order for the PPP loan to be forgiven, you have to spend the funds on specific expenses. The main expense is payroll costs, because again, the whole purpose of this program is to make sure that your organization can continue to employ and pay your employees. So what are payroll costs? And again, payroll costs, that's the portion that you need to spend at least 60% or more in order to receive forgiveness of the loan. So payroll costs are gross salary, group life, disability, health insurance, dental and vision insurance, retirement contributions, and state and local taxes paid. And they've just recently come out and kind of given more guidance on what is considered payroll costs. So they've expanded that a bit, which is great. Other expenses that you can use with this funding are rent, mortgage interest, and utilities. And then also some covered operation expenditures, covered property damage, covered supplier costs, and covered worker protection expenditures. And the slide here gives a little bit more examples of what each of those include. So we have also now have a second draw available for the PPP funding. So second draws are for those organizations that have already received their first draw. So they've already received one draw, they spent that funding, so they may be able to go back and get a second draw through this program. It again is issued through the SBA and administered by banks. If you already received a first draw and would like to have a second draw, you can use the same bank as you did for your first draw, or you may use a different bank. It's totally up to you. One thing to keep in mind though is if you already used a certain bank for your first draw, they may already have a lot of information that they might not request for the second draw. So it's perfectly fine to switch banks, but just kind of remember that if you had a good relationship, a good process with that first bank, there might not be any reason to change to another bank. The application period for the second draw is also through March 31st or until the funds are remaining. So if they run out, they run out, and it might not last till March 31st. And again, I have a link included in the slide if you'd like to go online to see what the application looks like. Same with the first draw. The second draw is also to help businesses keep their workforce employed during the pandemic. The eligibility for the second draw is basically the same as the first draw. However, they have added a few additional items. You must be in operation on February 15th. 501c3 organizations can again apply. However, for this round, you have to have 300 or fewer employees. The first round was 500, so they have changed that. Again, 501c6 organizations are eligible for the second round. You must also continue to have that good faith certification that the current economic uncertainty makes the loans necessary to support the ongoing operation. So that's a big piece of it that we have to remember that we can certify to. Again, you cannot receive both a shuttered venue operators grant and a PPP loan. So you'll have to determine which of those is best for your organization. In order to get the second draw from the PPP loan, we have to make sure that we either have spent or will use all of the first draw. So doesn't necessarily mean that you have to have your first draw forgiven, but you have to have it spent or will have it spent by the time you get the second draw. And then the big one is that your organization can demonstrate at least a 25% reduction in gross receipts between comparable quarters in 2019 and 2020. So looking at, either first quarter, second quarter, whatever quarter in 19 compared to 20 has to be the same quarter. Did you receive or did you demonstrate at least a 25% reduction in gross receipts? So what does that mean? Well, they have given us some guidance, and this is word for word what the guidance says. So obviously I'm not going to read this to you. You can see that it has a lot of words in it. So basically it means all of your gross receipts. So nonprofits get gross receipts from a lot of different sources. So let's take a look a little bit more in detail as to what that means. So they have specifically come out and said, okay, so for a nonprofit, if you're going to calculate your gross receipts using your Form 990, which is your annual return you file with the IRS, here's what you do. You look at the total revenue on page 9 at the very bottom, and then you're going to back out all of the expenses that are on that page. So on the 990, we net the rental expenses, the cost of sales, direct fundraising expenses, direct gaming expenses, and cost of goods sold on that page to come up with the revenue reported on the 990. However, for this purpose, for this test, we need to gross that revenue back up. So let's just take a look. And if you do a 990 EZ, here's the instructions, basically the same thing. Look at your total revenue and then add back the costs that are netted. So this is a picture of the 990 on the left and the 990 EZ on the right. And I've highlighted the lines that they're referring to. So basically you just go down to the very bottom, what is your revenue? And then you're just going to add back any of the expenses that have been netted out on the 990, because for this purposes, the SBA wants gross receipts, nothing netted against it. I have seen a few questions for nonprofits as far as should restricted money be included in this gross receipts, or should in-kind donated items be recorded in this gross receipts. And there has not been any kind of guidance that has specifically said that it should not. But if you do look at your 990, the total revenue here, it does include restricted money. So we think that restricted money should be included. It does not include donated facility space or donated services. So those two items are not included on your 990. So I would not include them in the test if you're trying to determine if you meet the 25% test. Realized gains are included in this amount on the 990, so I assume that they would be included in this test. However, unrealized gains are not included on these 2 pages of the 990, so I would not include them in the test. Another thing that has come up is promises to give. There is nothing, again, that says that those should be excluded, so I would include those as well. And you also want to use the same basis as what you would for your 990. So if you're on the accrual basis, you would do the test on the accrual basis. On the cash basis, you would do the test on the cash basis for that. The amount available for the second draw is a little bit different. The first draw was 10 million. This one is limited to 2 million. However, it still is up to 2.5 times the average monthly payroll cost during 2019 or 2020, again with a cap of $100,000 per employee annualized. The loan terms are the exact same as the first, 1%, maturity of 5 years, and again, it may be forgiven. Again, the same forgiveness applies to the second draw as the first draw. You need to make sure that you spend at least 60% of the proceeds on payroll costs. The remaining portion needs to be spent on those eligible expenses that we talked about. And then you have to have certain employee and compensation levels maintained. Again, just a reminder, here are the costs, the eligible costs for the PPP second draw, same as the first draw. Okay, so we now have kind of a newer grant that has been offered by the SBA. It's called the Shuttered Venue Operators Grant, or SVO grant. This is also through the SBA. The SBA has not yet started accepting applications. I have put a link to the SBA's website where this information can be found, and hopefully when they do start accepting applications, you'll be able to go to this website and get the application there. The purpose of this grant is emergency assistance for eligible venues affected by the pandemic. So this grant is a little bit more restricted as to who can actually apply. So as far as who can apply for this grant, you have to have been in operations as of February 29th, 2020. And again, you cannot have both a PPP loan or a Shuttered Venues grant. So we'll have to figure out, if you are eligible for both of them, which one is more beneficial to your organization. So the types of organizations that can apply for an SVO grant are the live venue operators or promoters, theatrical producers, live performing arts organization operators, museums, zoos, aquariums, motion picture theater operators, talent representatives. So these are really more of the arts organizations. So again, they have not started accepting applications for this grant yet. However, they do have a plan as to when they start accepting applications, who will be awarded the grants first. So those that have the greatest economic loss will have first priority. So in the first 14 days of the grant, so whenever those applications do become available, the first 14 days will be reserved for those organizations that suffered a 90% or greater revenue loss between April and December due to the pandemic. The second priority is then 70% greater revenue loss, and then 25% greater revenue loss, and then finally there'll be some additional supplemental funding. So even though the application is not available yet, if you believe your organization is eligible for an SVO grant and you think that that's something you might want to pursue, I think it would probably be a good idea to calculate your revenue loss between April and December, so that way you can see, okay, where are you at? Are you at the 90% level, 70%? So that way, when the applications do become available, you are ready to apply, and you can figure out which priority you meet. The amount available for the SVO grant depends when you were in operation. If you were in operation on January 1st, 2019, the amount of this grant is going to be the lesser of an amount equal to 45% of the gross earned revenue, or $10 million. If you were not in operation in January 1, 2019, but you opened after January 1st, 2019, you will be able to receive the lesser of the average monthly gross revenue for each full month in operation during 2019 multiplied by 6, or $10 million. So it is a pretty good amount for the grant. The SBO grant funds can be spent on items, expenses that are a little bit more available, a little bit more, there's more expenses that you can spend the SBO grant on than the PPP loan. Obviously payroll costs, rent, utilities, which are similar to the PPP loan. However, you can also spend it on debt payments, mortgage payment, worker protection expenditures, payments to independent contractors, other ordinary and necessary business expenses, administrative costs, state and local taxes and fees, operating leases, insurance payments, and then also advertising and other expenses related to theatrical or arts production. So it's a little bit more expanded as far as what you can spend this money on. So again, if this is a grant that your organization may be eligible for, it's probably a good idea to see, okay, are we eligible for both the PPP loan and the SBO grant? And if we are, which one is going to be better for our organization? Okay, the final government assistance type credit grant loan that we are going to talk about today is the employee retention credit. And this, I'm sure many of you are familiar with. And if you did receive a PPP loan, you probably did not receive or file any kind of credit for this because previously in 2020, PPP borrowers were not eligible for this credit. However, they just recently came out in 2021 and said that yes, if you did receive a PPP loan, you can take the employee retention credit as well. However, you cannot use the same cost. And that's really true for all of these different funding programs. You can't double dip. You can't use the same cost for more than one credit or program. So the ERC is a payroll tax credit that encourages organizations to retain employees during the pandemic. It was originally set to expire December 31st, 2020, but it has been extended to the first 2 quarters of 2021. What is important to know is that if you did not take the credit in 2020, maybe because you had a PPP loan, so you didn't think you were eligible, or you just didn't look into it, you are eligible to go back and take the credit for 2020. So that is something that you definitely want to look into because these credits can be pretty large. I believe right now that in order to get the credit for 2020, you're going to have to go back and amend your 941s from the prior year. There is some discussion that there might be a different form or a different way to get those credits, but as of right now, you really have to just go back and amend your 2020 941s. So as I said, refer to the 941s, and that's how you're going to get the credit because this credit is through the IRS, and it is a credit against the employer share of the Social Security tax, only the 6.2 portion. The credit is taken against the employer share of Social Security on the quarterly 941s. And so if you file for the credit and your credit amount is larger than your 941 amount that's on there, you're going to get that full amount credit back. It's just not limited to what you have reported. Whatever credit that you have is what you're going to get for this ERC. So because there was it's expired in 2020 and then it was kind of restarted in 2021, there are different rules for the ERC in 2020 versus 2021. So first we'll look at the 2020 credits. So that was from March 13th, 2020 to December 31st, 2020. So to be eligible to take this credit for the 2020 period, you have to have operated a trade or business during 2020, and you had to either experience a full or partial suspension of business operations during the quarter because of the pandemic, or a significant decline in gross receipts of at least 50%. So you either basically had to be forced to close down or partially close down, or had a 50% or more gross receipts decline. The amount of credit for 2020 was 50% of qualifying wages paid up to $10,000 per employee for all quarters of wages paid in 2020. So that is $10,000 per employee for the whole entire year. So March 13th, 2020 to December 31st, 2020, $10,000 in total per employee. If you had more than 100 employees, the credit is for wages paid to employees that did not provide services during you had suspended operations or the decline in revenue. If you had 100 or less employees, the credit was for all employees, no matter if they were providing services or not. And again, can't use the same costs for the PPP as we are for the ERC. So then this was revamped in 2021. So here's the 2021 rules. Again, eligibility must be operating a trade or business during 2020. And you must either have experienced a full or partial suspension of business operations during the first or second quarter of 2021. So that's pretty much the same, where you closed or forced to close or a majority of your business in the first 2 quarters of 2021. And the second one is, or a significant decline in gross receipts of at least 20% in either first or second quarter of 2021, as compared to the same quarter in 2019. Now in 2020, the significant decline in gross receipts was 50%. So they have reduced this down to 20%. So also in 2021, they changed the amount of the credit. So in 2020, it was 50% of qualifying wages. They've increased that to 70%. And in 2020, it was also $10,000 for the per employee for the whole entire year. And they've changed that in 2021 to be $10,000 per quarter per employee. So obviously that's more beneficial for the employer in 2021. The amount of wages as far as employees providing services versus not providing services, there is still a difference between those two, just as in 2020. However, they've increased it to 500 employees as opposed to 100 employees. And again, we can't use the same expenses for the PPP and the ERC. So that's kind of an overview of the government grants assistance that are currently available for nonprofits. So let's say your organization gets some of these. So the next question is, how are we going to record these on our financial statements? So the very first one that we talked about, the EIDL, that is actually a loan. So if you were one of these select few at the beginning that were able to get that up to $10,000 forgivable portion, that's going to be recorded as a grant. However, most of the funding from the EIDL is a straight out loan. So you're going to record that as you would with any other loan and accrue interest. The EIDL loans are also subject to the single audit requirements. So nonprofits that receive and spend more than $750,000 of government funding in a year are required to have a single audit, a special audit. And when you go to calculate that government funding, the EIDL loan must be included in that. The PPP program loans funding, it kind of depends. There's a couple different options. So if you receive a PPP funding and you assume that you're not going to be able to get it forgiven, or a portion of it is not going to be forgiven, then you're going to want to record that part as debt, as a loan on your financial statements. However, if you received a PPP loan and you are expecting to spend 60% or more for payroll and the rest of it on those eligible expenses, and that you are going to meet the requirement for to maintain a certain level of employees, and you think that it's going to be forgiven, then you can record it as a conditional grant. So when you record it as a conditional grant on your financial statements, that's going to be recorded as a refundable advance, as a liability. And then when you receive forgiveness, the condition of the grant, it's going to be moved from a liability into revenue. So it's really the organization's decision as to how they record it, a liability debt versus liability as a conditional grant. However, you need to maintain documentation as to why you are recording it one way or the other. Also with the conditional grant, some people take the approach that if I have spent all the money on what I'm supposed to be spending it on and I've maintained the certain employee salary levels, then the condition has been met and I'm going to release it and move it to revenue. Other people say that the condition has not been met until the SBA actually grants that forgiveness. And then at that time is when they're going to release it into revenue. It's up to you which approach that you take. But again, you just need to document what your organization is saying as far as when the condition is met. Unlike the EIDL loan that is subject to the single audit requirements, PPP funding is not subject to the single audit requirements. Also, again, with PPP and all of these, we don't want to double up, no double dipping. And then also, if you do receive government money, government grants for other programs that do pay for salaries, we can't use those government grant reimbursements and the PPP funding for the same salaries. So again, no double dipping with the government funds. The SBO grant, when they start issuing those are going to be grants, so revenue. And then the ERC, those credits are going to be recorded as miscellaneous income on your books. We don't want to net those against payroll taxes or payroll because then that will skew your payroll expenses and your payroll taxes. So those are going to be recorded as miscellaneous income. So now moving on to some updates that we think that you should be aware of. As I said, certain nonprofit organizations that receive or spend more than $750,000 of government money are required to have a special kind of audit done, a single audit. And when that audit is done, the auditor looks at different compliance requirements and testing. And in order to do that, they refer to the compliance supplement, which is issued by the Office of Management and Budget. And they issued that supplement back in August of 2020. But then they issued an addendum in December because of the CARES Act. So organizations that received government money from the CARES Act should probably be aware of that addendum that was issued because there's probably some additional information as far as compliance requirements, what needs to be tested if you do receive a single audit. So just make sure that you are aware that if you received CARES Act funding, that you look at that addendum to make sure that you're following all those regulations. As part of the single audit, there's also a report that needs to be submitted, and the OMB is offering a 3-month extension for certain types of single audits because of the pandemic. As far as just general accounting updates, back in 2018 for calendar years, 2019 for fiscal years, there was a very large redo of the nonprofit financial statements. We changed unrestricted, temporarily restricted, and permanently restricted net assets to net assets with donor restrictions and without donor restrictions. There were some other changes to the statement of cash flows. There was additional disclosures related to allocation of expenses and how we allocate those. And then there was also additional disclosures on liquidity that we added. So a large, huge overhaul in 2018 and 19. Then they decided, okay, let's look at the revenue. So in 2019, which had then got pushed back to 2020 for calendar years, there was a new standard on revenue. So those organizations that receive earned revenue, that have program service revenue, fee for service, those types of things, that's really going to apply to you. So if you did not early adopt that in 2019, your organization will need to adopt that in 2020. And then they also recently had a nonprofit specific standard on clarifying the scope and accounting guidance for contributions received and contributions made. That was implemented in 2019 for calendar years, 2020 for fiscal years. That really just kind of clarified, all right, what is considered a grant and a contribution versus what is considered a fee for service. So that's kind of what's recently happened. So we don't have a huge lot amount in calendar year 2020 unless you haven't implemented that revenue standard. However, going forward, we want you to be aware that there will be some additional requirements for in-kind. So those of you that receive donated goods, services, facility space, that type of thing, you are going to have to, if you don't already, separate those in-kind contributions on your statement of activities. So right now, many organizations will just have one line called contributions on the statement of activities, and that will include both cash and non-cash contributions. However, the standard setting boards decided that we need to separate those because it's going to be more beneficial for the reader to see what is the cash contributions versus what is the in-kind contributions. So if you don't already separate those, that might be something to put in a plan as to how you're going to separate those on your GL, your trial balance. And then also in your financial statements, if you have audited or reviewed financial statements that have footnotes, you're going to have to include some additional disclosures on the in-kind. You're going to have to describe more of what type of in-kind is it, whether it was used by the organization or whether it was sold, and then like what's the organization's process for selling donated items, and then how the fair value of the contribution was determined. So most of the information you probably already have, or most of it you have. It's just including it in the financial statements a little bit different way. So we just want to make you aware that that will be coming up here shortly. As far as tax updates from the IRS, they issued the Taxpayer First Act, which says that now Form 990s need to be e-filed with the IRS, so no more paper filings. So organizations with the year end of July 31st, 2020 or later have to e-file their 990. Those organizations that are a little bit smaller that filed the 990 EZ, that is been postponed for 1 year. So you have until July 31st, 2021 to start e-filing. Organizations that have unrelated business income that file Form 990T are required to e-file those starting this year. So if you are filing a 990T with a 2020 at the top of that form, you are required to e-file that form. And along with the 990T, there is a change in the schedule. They've changed the form a little bit to address the siloing rules that were put into place. So for example, a nonprofit that has unrelated business income from both advertising and rental income. Previously, if you had a loss on one of those and a gain revenue on the other one, you could net those two together. However, they've decided that we're not going to allow that anymore. So those need to be siloed. They need to be separated. And so the new form just kind of better addresses that approach. So now moving on to some items that we think are pretty important for the pandemic and the remote workforce and just all the stuff that's going on with the current world right now. First, controls for remote workforce. So many organizations have gone to either full-time remote workforce or part-time. Maybe you're only coming into the office 1 or 2 days a week. But regardless, we need to make sure that we are still implementing and following our controls. Same principles apply as we were doing it in person the old way. So we need to look, okay, what do we have set up currently? What could go wrong with how we have it set up? How are we going to address that risk? So just like when we were all in the office where we had segregation of duties between authorizing transactions, recording transactions, and maintaining custody of assets, we need to continue that in the remote world. So one thing that I know has come into play a lot is the accounting software that's in the cloud. So I know a lot of organizations will use QuickBooks Online. As with software that's on our computer, we want to make sure that every user has a unique username and password so we can clearly see who enters the software, who makes the different transactions, journal entries, that type of thing. And then just restrict access to only those areas where that individual needs access to do their job. Some organizations have gone to a bank's online bill pay. I know one organization who used the online bill pay for reoccurring payments. And since they've gone to more of a remote workforce, they've started using that for all of their payments, which is perfectly fine. We just need to make sure, again, that we have proper controls in place. So requiring the check signer to log in to approve disbursements. Under no circumstances should only one individual be in control of setting up and executing payments. So maybe having one person set up who the authorized vendors are, one person log in and say, okay, these are the checks that need to be made, and then another person logging in and say, yes, check those, we can make those payments. Another software that a lot of organizations use is Bill.com. Not saying that this is a good software or bad software, just know that it's out there and a lot of people do use it. So if you are using it, you might want to consider to assign roles to each person that is involved in the process. And what's really nice about this is it can be done from different locations. So let's say you have a bookkeeper, a finance director, and an executive director that are all working from their own homes. You can set it up where the bookkeeper enters the bill to be paid. The finance director or the CFO logs in and approves it, and then the executive director will electronically execute the payment, and it will show in the software who does that, so we can easily track the controls that are in place. Also with Bill.com, it really serves as a virtual file cabinet online. So you can see the invoice backup, the proof of payment, all, the check image, the EFT, all of that online. So it's all right there, very nicely organized. Just a reminder to make sure that you are performing regular backups. Many large scale providers for web-based products have frequent backups. Just want to make sure that they do, and that your information is being backed up. And again, with security, it's so important with all the use of technology these days that people should only have the level of access that they need to do their job. Again, passwords, maybe even consider using the multi-factor authentication where multiple forms of verification are required to provide your identity when signing into an application. So again, just provide some extra security on all of that technology that's being used. Okay, let's switch to fundraising. And I know a lot of nonprofits have really had to change their fundraising approach now that we can't meet in person. So Giving USA conducted an online survey of nonprofit professionals and wanted to see how the pandemic affected them in their outlook for 2021. So the first question was basically, how did you do in 2020? So 56% raised less than their budgeted. 33% raised in line with expectations, and 11% raised more than their original goal. So not surprising that most raised less than their budgeted amount, just because a lot of fundraising events were canceled or postponed. They then went on to ask them, of those nonprofits that normally hold one or more fundraising events annually, what happened in 2020? So 46% canceled an event, 40% postponed an event, 62% actually converted to a virtual fundraising event, and 19% converted to a hybrid event. And then they said, okay, of those organizations that are planning to host one or more events in 2021, how are you going to do it? And it was pretty even across the board, with organizations looking at having live events, hybrid events, and virtual events. So what can we do now in this different fundraising area that we need to figure out how we're going to continue to raise funds for our organization when we can't get in front of our donors and meet in person? Well, I think we want to make sure that our donors are aware that there is an increased charitable deductions for taxpayers that are not itemizing. It is, $300, which is not huge, but, maybe it might give an incentive to some of those smaller individuals. The amount is $600 for filing jointly in 2021. Virtual fundraisers is a big thing. Having a 5K or a gala, gaming tournaments, or a concert online, and then encourage your participants, to take pictures and post them to their social media and tag your organization in the event, so people can see, hey, look at all the fun we're having. We're raising money for this great organization and all the good things that they do. Now's the time to also thank your existing donors and volunteers. Let them know that your nonprofit is continuing to pursue the mission, even in this crazy, uncertain time. Communicate all of the good things that your organization is able to do and accomplish with their donations. Send personalized thank you notes. Give special recognition to major or longtime donors. And obviously you want to do this in person or, virtually in person, or, send them thank you notes. But also you might want to consider, also updating your social media, keeping that up to date, telling people what your organization is doing. And finally, don't be afraid to ask for support. You never know how the pandemic is going to affect someone. I've heard some organizations, obviously, that are really hard hurting because they had to, cut their programs, so their program service fees are really down. But other organizations are receiving a lot of contributions, and their contributions have actually increased because of all the people out there that have seen the good things that they're doing and want to help them. So don't be afraid to ask. The worst that can happen is they can say no. Also consider collaborations with other nonprofits, other businesses, other churches, maybe someone that you wouldn't necessarily think of, but this might be a time to, hey, maybe we can get together and do some kind of special event. Continue to tell your story. As I said, utilize your website, social media, let people know that you are still out there doing good work and that they can support you still. And finally, don't stop fundraising, especially in this critical time of all the good work that your organization is doing. You don't want to lose that support. So I know it's hard, but just continue to fundraise and for your organization so that your organization can continue to do its mission. And along with fundraising, also budgeting. Now is it's kind of difficult to budget when you don't know for sure what's going to happen. So obviously we all have a budget, a plan as to where we're getting our funds from and what we're going to spend them on during the year. But if we are don't know about where our funds are coming, or if especially if there's a major change in a funding source, we need to revisit the budget. It's okay to make a change to your budget if something major happens, like a pandemic. If you had to close your certain program, or you stopped getting that grant from that major funder, we really need to relook at our budget to see, okay, where are we at now? We also need to make sure that we understand our financial position during this time. If we do, have to close down a program or we lose a big funder, what costs are going to be affected? How is that going to affect our overall organization? A lot of times those fixed costs, like the salaries and the rent, don't change. That's why they're called fixed costs, because they're pretty much the same from year to year. However, with the pandemic, there's all kinds of crazy things that have happened, and those costs that are relatively stable, like payroll and even rent, they may change. So just got to remember that when you're doing your budgeting. Also encourage you to maybe do some multiple budgets, what if scenarios for different levels of revenue decline. What if we lose 10% of our revenue? What if we lose 30% of our revenue? So that way we kind of have some plans. Okay, if this happens, let's be proactive. What can we do about it? Many organizations also use rolling budgets. This is more popular in those more volatile situations. For example, budgeting 4 quarters ahead. So that means that each quarter the budget is updated for the subsequent 3 quarters and then a 4th quarter. So we're kind of continuously looking at it, continuously adjusting it, so we know, with all the changes where we're at going forward. Whichever kind of budget you use, you need to make sure that you continue to monitor your budget to actual, so that way you know where you're at and what you need to do if any changes need to be made. We also need to make sure that we're managing cash flows. Doing cash projections is really important during this time, especially if you have reduced funding. Also, monitor your receivables. How much is out there? Are we likely to collect these? Is there any opportunity for additional COVID-19 grants? Can we get any of those government assistance? What kind of financing options are out there? Should we be going to get some loans or line of credit or something like that to help support the loss of funding and the cash decline? And then finally, board designation. So maybe we have some money that the board had set aside for X, for this capital campaign or this specific program or something like that. Should we be asking the board to undesignate that because that maybe we need that cash right now. So not saying that you should or shouldn't, but it's something definitely to think about. And then finally, just, we're going to survive this pandemic. I know it's a tough time right now for a lot of nonprofits. Many people are out there that need your help, and you have a lot fewer resources likely than normal. I think a big thing is communication, making sure that you are in communication with your staff, with management, with the board. Everybody knows what's going on. And just, working together, not only within your organization, but with other nonprofits. I know that there's some different nonprofit groups in town that get together and talk about different things. And I think now is a really good time to, see what other nonprofits are doing, and and maybe there is some opportunity to work together for fundraising or, different kinds of events or programs. But use this time as an opportunity to see what's out there that we can do that maybe we hadn't thought of before. But because of this pandemic, we're kind of forced to think outside the box and see where we can get to. Well, thank you so much for attending our webinars today. I put my contact information on the last screen. I encourage you, if you have any questions or need any assistance, please feel free to reach out to me. We do have a specific nonprofit blog called Mission Minded on our website that includes specific information to nonprofits, accounting, fundraising, board governance, all types of things. So I encourage you to use that. I'm also on LinkedIn as well as DWD, so feel free to reach out and connect with us there. Again, thank you for joining us today.